Welcome back to Your Finance TV with a special episode covering commercial real estate, and we welcome David Auerbach from Armada ETF Advisors to break it down for us. Welcome to the show, David.
Scott, great to see you. Thanks for having me. I appreciate it.
Oh, you're very welcome. Before we kick off, don't forget to click on that subscribe button below and the like buttons. Numbers grow each week, and we can keep you up to date with everything and everyone we're talking to. Now, last week, Morgan Stanley issued a note that almost $1.5 trillion of US commercial real estate debt comes due for repayment before the end of 2025. So refinancing risks are front and center. David, when we hear numbers like 1.5 trillion being thrown around, there is a fear factor that goes with that number. Is this headline just clickbait for readers, or is this a legitimate concern for investors?
The answer is it's both, actually. No question it's a clickbait headline that draws you into the post, but in the same breath, there are some troubling stories that are out there, but there's also some very bright spots that kind of go under the radar. And because of the world of real estate investment trusts, or REITs, which are interest rate sensitive, which is an interest rate sensitive sector, everything is being lumped into one little wrapper. And so it's up to me to kind of break out some of those pieces for you. So let's focus on the commercial real estate debt aspect that Morgan Stanley is talking about. There's no question about it that there's a lot of debt that's coming due over the next few years. Especially in some of these office properties across the country that we're focused on. And yeah, we know what's happening in the office market. We have a great chart that's, that we'll show here, talking about how lease rates have been declining, because we know that work from home is clearly here to stay. Now, you have stories that are out there from companies like JP Morgan this week, Goldman Sachs, some of the other big Wall Street firms that are telling their employees that they have to go back into the offices 5 days a week. So in a city like New York City, if you say, what's the work week right now? People would say Tuesday, Wednesday, Thursday, they're in the office. Monday, Friday is a work from home. I'm a Wall Street guy. Back when I started on my desk, unfortunately, after 9/11, what happened across Wall Street was many Wall Street companies set up what they call disaster recovery offices, where you would literally pay a second office lease and have a replicated office in case something happens to your primary office, that you could be up and running the next day in a similar setup. Now, because of what's happened through COVID, we clearly have shown that DROs are no longer necessary, because in the world of Zoom and computer sharing programs that are out there, you can log into your main terminal, be at home, and still be business as usual. Okay, so now that we talked about some of the debt that's coming due, let's focus on some of the good. For a lot of the publicly traded REITs that are out there, they took advantage during COVID lending conditions when the 10-year treasury rate was trading out 1.5% to refinance and recapitalize their balance sheet to the tunes of hundreds of billions of dollars across the spectrum. One common feature, just as a very high level example, one common feature that you would see would be X company is going to retire $300 million of 7% debt coming due in 2024, with $500 million of 4% debt coming due in 2027. So they were able to lower the interest rate and extend the maturity of that debt stack. We published a recent blog post on our website, armadaetfs.com, where we highlight the top 10 constituents of our residential REIT income ETF, ticker HOUSE. And in that presentation, we've talked about that in our top 10, right now, over the next 3 years, most of these guys only have about 20% of their debt coming due. If anything, the worst case scenario is it's about 30% that's coming due over the next 3 years. However, if you look after that window, most of these REITs right now have debt that are priced out 20, 30 years. And some of these, I think, when it's all said and done, when you average out the weight, it's around a 3.6 average percent interest rate on the debt yield across our top 10 constituents. With the 10-year trading around 3.4, 3.5%, that's pretty much right in line with current treasury rates. So from a very high level example, because these REITs own their own debt, they're not necessarily going to Signature Bank and Silicon Valley Bank and some of these other banks that we've been seeing in the news headlines right now. They self-fund their own debt. And so as a result, what's happening in a lot of the other sectors that are out there is not really impacting the REIT space. One more point to focus on. We focus on fundamentals. At the end of the day, pick any Wall Street company, REITs, Apple, IBM, Tesla, Intel, Microsoft, pick your favorite stock. You want that company to do four things. grow revenues, grow profits, grow dividends, and grow your annual guidance. Ignoring stock price performance, if a company is able to do those four things, you would assume that the fundamentals remain solid and that they're on solid ground. And pretty much by and large, across many of these REIT sectors, that's what we have been seeing. And so as a result, you kind of have to ignore some of the big attention grabbing headlines and really focus under the hood of the car of what's driving that motor down the road. Because really, some of these sectors like industrial, data centers, towers, multifamily, single family rental, these are sectors that are on really strong grounds right now, but yet everything because of performance is being lumped in together because we've seen interest rates go from 0 to 5% in a year.
Okay, so big banks may be reluctant to put up this type of risk, though, David, especially if interest rates remain around these current levels. With regional banks' balance sheets stretched, they may not be a source for refinancing like they have been in the past. Who do you think could be the main player in the refinancing space, and how could it change the REIT space?
So as I previously just mentioned, again, our REITs are not really working with the regional guys. They're working with the Goldman Sachses of the world, the JP Morgans of the world. You know, you look at any cover deal from an investment banker and you usually see the same list of 5 or 10 firms, all the big Wall Street wirehouse firms. Now, from a very, very, you know, big example here, I always talk about from this situation. If Walmart starts closing stores across the globe, we have bigger issues than Walmart just closing stores. If Coca-Cola or Budweiser starts closing bottlers across the globe, we have much bigger issues globally than just these companies closing canneries and bottlers. And what I imply is that, unfortunately, we saw news out of Credit Suisse over the past couple of weeks, and they are one of the larger banks that's out there. But if we start seeing this impacting JP Morgan, Bank of America, UBS, Goldman Sachs, again, some of these guys that we see on all the covers of the deals, at that point, then it gets to be a little bit more concerning. But remember, these REITs are not necessarily borrowing $700 million from Goldman Sachs. They are setting up a debt deal where they own the $700 million and they're making the interest payments back. And so it's a very different situation how the REITs self-manage their own debt versus just going and getting a loan from a bank, if that makes sense.
Okay, but would you think that the private equity side of the world, like obviously we know the Blackstones are in there and so forth, but do you think they might even step up even bigger?
I don't see those particular players being a lender to the companies. Now, if anything, there's like a lot of good sovereign wealth funds that are out there, like Government of Singapore, Canada Pension Plan. The list goes on, that are always looking for great real estate opportunities. If you can own the best property in the best city at the intersection of Main and Main at a 25 to 50% discount to NAV where things are currently trading at, those long-term sovereign wealth fund guys don't care about what's happening today. They're looking 10, 20, 30, 50 years down the road. And so they're looking to JV with a lot of these REITs and become their development partners or capital partners directly. But, you know, Blackstone start with the private equity guys, they're running their own portfolios. That's a whole separate conversation. I don't see them necessarily blending and getting into the public world because they've got their own platforms that they're focused on.
Okay. So there are a lot of concerns about the commercial real estate space right now, though, David. Like it's all in the press everywhere. With these concerns in the market, should investors be steering clear, or are there opportunities that investors should be looking at?
It's important for every single investor and professional to do their own homework. What causes something to be a buy for you, Scott, would be something different for me that causes it to be a buy. And I run an ETF. And so for us in the world of ETFs, we're focused on our underlying constituents. I've got 25 guys that I'm focused on in the world of residential REITs as an example. As a result, there is no question about it. There is definite opportunities in the marketplace. I always talk about, let's take it from a very high level. Scott, let me ask you a question. Have you gone to a Starbucks or your local coffee shop recently, big mass market coffee shop for a cup of coffee recently?
Well, I don't drink coffee, sadly, but
tea or something like that.
I know my daughter loves going to the Starbucks. Yeah,
Okay.
I've been to one. Yes.
What about your local pharmacy? We have CVS and Walgreens as our drugstores here. Have you gone to the local pharmacy in the past couple of months to pick up a prescription or something like that?
Yes. Yeah.
Here's a very tough one. I hope you're ready for this one. Have you gone to the grocery store and bought groceries recently?
Yes, I have. I love going to the grocery store.
In every single one of those examples, most likely you are interacting with a REIT owned property. And why I use this particular example is I always say anybody can't go from point A to point B without being hit in the face by a REIT owned property. We interact with REITs every single days of our lives. There's this category of REITs out there called necessity based retail. That's again I'm going to the drugstore. I'm going to the coffee shop. I'm going to the grocery store. I'm going to the local Chipotle to pick up a burrito. The things that were very popular during COVID, the drive-through lines at the local fast food restaurant stuff. Regardless of what's happening with interest rates and stuff, consumers are going out there and spending. And so as a result, I always say, do you interact with these properties? Look at the property that's the intersection, what I call Main and Main, where the most traffic flows through. And there's a great shopping center that happens to be based there. And you always see that the parking lot is full. And you see that it's got a brand new coat of paint on it, a great shiny sign. Like you can always tell, like, wow, that's a really nice property. It seems to be really busy. Who owns that? Oh, I see that's this company called Brixmor. Okay. Brixmor, what else do they own? You go to their website and you see that they own a lot of other stuff across the country. And again, most likely at the intersection of Main and Main are very well traffic populated areas. And so then you get the ball starts rolling in your head. How do I make money off of Brixmor? So I use that as an example when we talk about like our residential fund. This is simple. When you think about REITs, you think about dividends because the income that's earned by these REIT-owned properties, the tenant pays the landlord rent. The landlord then turns around, pays 90+%, if not all of that rent back to you, the investor, in the form of dividends. So for us in a residential fund, residential rental fund, that rent check that you pay to the apartment landlord or the single family rental landlord, that rent check goes back into your pocket in the form of dividend income. So we focus on the here and now. Employment is strong. The rent check is getting paid. In the certain markets where there's big migration trends, especially here in the States, when you look at places like, let's say, Nashville and Charlotte and Raleigh, and the list goes on and on. Well, we know because interest rates, a 30-year mortgage rate's north of 7% right now. Housing prices remain very elevated. It is very expensive to buy a house. If you are the average family of two trying to buy that first-time house, it's unaffordable right now. And as a result, it's this rental landlord that's in the driver's seat to capture that demand. And then if you look at cities, like I mentioned, like Nashville and Charlotte, et cetera, because there's so much of an influx of migration trends into these cities, we know that the rent numbers are going up. We don't have to tell you. The companies tell you that themselves every quarter because publicly traded REITs disclose earnings. They put out press releases. They host conference calls. They're very transparent, telling you what's going on. In their earnings releases, they tell you every single city they're invested in. Here's how much our rent grew. Here's where we see things going. And so for us, it's not where we'll use terms like, for you, rugby or pitch. It's not where the ball is on the pitch. It's where it's going. When you watch a beautiful play come into motion and you're able to see it 2 steps ahead, like, dude, he's passing to that guy over there. I'm telling you, I can see it all coming into motion and it happens. It's the same thing for these guys. It's not where we're at today. It's where's that puck going so that what's the next city to develop in? Is it going to be Provo, Utah? Is it going to be Spokane, Washington? Who knows what that next Raleigh or Charlotte's going to be? But our residential guys do know where those trends are going. And so for us, our goal is to maximize that rental payment, which means that maximum hopeful dividend income in your pocket.
David, thank you so much for your time. I think we're going to have to get you back to talk about the more on the residential side as well.
Love it, Scott. Thank you so much, buddy.
And for everyone else out there, good luck investing.